Analysis edition. This is our final show, Jace. We've done 14. Well done. Good on you. Congratulations.
Yeah, it's flown by, hasn't it? It's been good. Hopefully, all the viewers watching have got some interesting ideas from it. That's what it's all about, passing on those ideas, those maybe some thought processes which otherwise they mightn't have passed, they mightn't have been going down. So yeah, hopefully it's been good.
Yeah, I think they have, and I certainly have as well. Like I think I've had a lot of realizations and confirmations over this series. So once again, I say it every week. Thanks for coming. Thanks for helping me with this series, which it was a bit of a once again a bit of a passion project of mine for the company as well, I guess. But it's a personal thing of mine to want to educate others. And I also want to thank the audience for coming along. Giving us those likes, giving us those comments, and giving us those, just the reassurance that we're on the right track in giving good education, good general advice, good education, right? So, but 14 shows, Jace. For me, it was once again, it was a bit of a learning curve in this because I've never done anything like this, and I know you're an expert at this sort of stuff. Can I just ask, sort of, what do you get out of doing these? What do you get out of doing these kind of shows?
I always enjoy talking about charts and technical analysis and markets generally. It's just one of those interest areas which I have, and also it's the business which I've operated in. I've operated in markets for coming up to, I think it's over 30 years now, going back to 1991. So yeah, look, always having a chat about charts and things is interesting, and also people like hearing what we're talking about. They're interested. They come across the Motion Trader and see the sort of stuff I'm doing there. And of course, I'm running a business off this as well, so I do enjoy talking about it. But then also, like, it's something which I run as a business as well as running my own portfolio. So pretty much everything I do in the business world all comes back down into these markets.
Yeah, and what I love, once again, what I loved about what you did, Jason, is you did, a lot of educators don't really show what they're doing, whereas you did. And I think some of the comments that I see at times is like, well, why don't you just give us everything and let's just see if your system works, right? But unfortunately, I don't think that's the point, and I don't think that would work anyway, right? Because even if you gave every signal to everyone, then it just, depending on the timing of the market, there's just so many variables that to take into account. You couldn't just give someone 12 months of free service and then expect them to come out with a result that says, oh yeah, it works, or it doesn't. That just doesn't. That's not how the markets work, right? So
really interesting. So you'll be familiar with the turtles, the turtle traders. So this is a great story going back to the early 1980s. A famed Wall Street trader, a guy called Richard Dennis, and his partner Bill Eckhart. They ran this experiment. Could they train everyday people to be great traders? Was it something people were born with, or was it something which could be taught? And they brought in this group of people. I think it was 12 in the initial group. They ended up doing it 2 or 3 times, and they basically proved you could teach people to trade by giving them a system, a set of rules to follow, and they could follow the rules. They could make money. But the point I want to make here, based on what you just said, Richard said something along the lines of that he could publish the rules to his trading system in the Wall Street Journal and show that it worked and everything, and people still couldn't make money with it because they short circuit it some way. They'd follow this rule and ignore that rule and second guess and do all other variations of things. So it's it's like you can put something on a tray and hand it to someone, but unless they've got a genuine interest in understanding what makes it work and how it works and following something, it's it doesn't matter how good it is, not everyone's going to be able to make it work for them.
Yeah, exactly true. And the whole point of this series is to teach people how they can fish in some sense and not just give them the fish, because we can't anyway, right? It's we can only do general commentary around stocks that people might tell us. We can't just go out and say, hey, you need to get this, or you have to. It's just, we don't do personal advice at all. Selfwealth does, and nor do you, right, Jace? So it's one of those things where, look, we love what we do. We love educating people, but Yeah, please don't ask it. Just don't. It will go along the lines of, oh yeah, we'll give you all our tips and then we'll see if it works. Unfortunately, that just doesn't work that way, right? So, all right, but let's talk about what we've got a few questions from the audience today. Got a few tickers already come in from the guys. Good morning.
Just first of all, Rog, if I can just stop you for a
Oh,
second.
the general disclaimer.
Just want to say,
Sorry. Yes, do that.
general
Please.
advice. Everything we're doing today is general advice only. No personal advice there. I'll quickly put up our disclaimer, which just explains all that. I'm not part of Selfwealth. I'm a motion trader. My license details are in that disclaimer there. And yeah, have a read of that. If you need anything specific to you, you've got to go get your own personal advisor. But if you want to just learn some general stuff about markets, you're in the right place to get some general stuff from Roger and myself. And Roger, of course, is part of Selfwealth.
Thanks, Jace. Yep, exactly. And I thought that was the perfect lead-in, and I forgot to give you the lead-in, right? So, but that's okay. We're working on it. All right. So today's general topic, which I wanted to talk about, we'll start with that before we get into the comments from our lovely team on the other side of on the computers. What about we want to talk about divergence? I started using this a while ago in my trading, but then I kind of gave up on it because once again it was just an extra thing that I didn't want to have to track. I want to keep it simple. But are you able to explain to us what is divergence, Jason? How do we pick this up on the charts? How do we pick this up on the charts?
Yeah. Look, divergence is something which can appear across a range of different measures. So it could be with looking at a market and combining that with an indicator, or it could be looking at different sectors, or it could appear within different indices. It's but basically what it is, it's non-confirmation. You're looking for a movement in one market or stock not being confirmed by something else, be it another index or indicator, whatever it may be. It's an interesting thing. It's I wouldn't call it a primary indicator for me. It's probably not even a secondary. It's probably more of a tertiary one. So there's other things which I'll rank above divergence. It's not something I'm actively going out to look for, but it's something which I will notice at times, and it's one piece of a broader puzzle which can come together to maybe give some clues as to a market which could be becoming overstretched and ready to will having the potential to make some sort of a turn. And I think that we'll go through some examples. So I'll it always looks, things are always good when you see something. So let's have some examples. So I'm going to use this. I'm going to use the S&P 500. We could use any stock index, but I'll use the S&P 500 for this. And also the other interesting thing with back testing is so it was interesting how you said you hadn't really found a way to make it work for you, Rog. It's like one of the things I did was a few years ago now. I thought, look, can I I actually want to see whether this divergence works or whether it doesn't work. So I back tested. I came up with some code to work out like how I could back test divergence, and it turned out that it didn't provide an edge. I couldn't find a way to systematically apply it as a rules-based approach to gain an edge over the market, over the stocks generally. So for me, it's very much a discretionary thing. It's something by looking at a lot of charts over a lot of years and just using it as a factor which I may use or I may ignore. But yeah, I couldn't make it work from that algorithmic consistency rules-based approach. I think it's more of something you get a feel for. It's more of an art, I think, than a science. But it is an art which can be worthwhile understanding. So I'm going to go to my indicators. Now you can use all sorts of indicators for this, but I'm going to use the relative strength indicator, the RSI. That's the one I use when I'm looking for divergence. And so this is the RSI down below. Looks like a whole lot of squiggly lines. It's hard to initially think, look, how does all this work? But we'll just go through and just look for some examples which could have been helpful in the recent past. And probably for me, the one which was most helpful recently was October last year, where you can see the S&P 500 it fell to a new low, but then when we look at the RSI at the same time, you can see the RSI makes a low on the 23rd of September with the S&P 500 has a rally, market makes a new low, RSI rally increases, then it doesn't make a new low. So that's what we call divergence, where the RSI hasn't fallen with the same momentum as the underlying index, and that's giving you an indication that maybe the market's become oversold and it's due for a reversal. It doesn't necessarily have to be a major reversal which lasts for months, but it's showing it's at some point of being unsustainably oversold and needs to react back in the opposite direction. And what we would have seen at the time. So you can I'll just move this there, and you can see the low being made, and you can see where the RSI is. So this is what we would have seen in real time. This is what you would have been making the decision of. And then the market, we just move along a little bit more of time. You can see the market starts to rise, the RSI starts to rise, and you get that clear divergence. So a strategy for playing that could have been going, well, okay, it looks like there's a state of oversold being now corrected. One strategy could be to say, look, I'll buy whatever the underlying product is. In this case, the S&P 500. I could put a stop loss below the previous low point. So it's a relatively you could potentially get a relatively low risk entry for good potential upside, depending on where that market ran to. So that's one way it could be used. It goes against the principle of like a market being below moving averages. I often talk about I don't want to buy a stock or a market which is below moving averages. But when you're looking to use a divergence in an RSI, and you want to use some sort of a trading strategy, there is a pathway where that could be worth considering. Another example we have is, I can see one just here, and this was another low point. This was in early 2022. You can see the market makes a new low. When we go across and look at the RSI, RSI doesn't follow through. So you could do the same principle I was talking about before, in that you can see this is what we would have been seeing in real time, saying, okay, the market seems to be bouncing. It's been below the moving averages. At this point, we could have been saying maybe that was the end of the pullback to this. We had this big rally. We've had a pullback. Maybe that's it. Maybe it's going to go and make new highs. That was a potential scenario. So one way to play that would be to buy a position, put a relatively close stop below the previous low, see what happens. We see what happens, market comes back, doesn't make a new low, so we stay in the position, market starts to rally, looking good, but then as we know, it all falls down. So if you were a shorter term trader, you might have had a close trailing stop. Different ways that could have been played, but that's not the point of what we're talking about at the moment. It's just looking for those potential points where a market could change direction. But it's far from foolproof, because you look at this example here. Like, let's look at this example. I can see, looking at this, you can see that the RSI isn't making new highs. This is in April 2021, but the S&P 500 is. So none of these things work all the time, and we need to combine them with other factors as well. I don't like, as a general statement, I don't like trying to pick the high and pick the low. It'd be more for me in this situation, maybe I'd just become a little bit cautious about entering stocks. Maybe we could have said, look, this has been a long upward run. We're getting some divergence. Maybe we could get some sort of a consolidation. But it was the briefest of consolidations, and the market kept marching upwards. So you've got to be careful that you don't use an indicator like, or you don't use a situation like divergence to box yourself into a position where you then go, okay, well, I've exited the market because everything, I could see some divergence, and now the market's rallying and I've sold. Or I've gone short based on divergence, and that can be that can be problematic as well. So understanding the situation we're looking for, but knowing that it's certainly not going to play out every time. And this is what I found in my back testing. So it's understanding what the setup looks like, and then seeing how it connects with other dots that you need to look at as well. There's an interesting situation prior to the COVID crash. Just looking at how the RSI performed then. And you can see the market made new highs, and the RSI kept not confirming. So of course, the RSI wasn't predicted the COVID crash, but it was saying there was the underlying momentum was potentially starting to wane. So it was an early warning sign. I didn't pick up on it. I wasn't looking, because I don't actively look at RSIs all the time, which is a bugger in hindsight for me, because I could have been more across maybe managing some risk than I was. But yeah, there was clear divergence at the time. So it's an interesting one to be aware of. I'll show you some current ones. So these are all hindsight. So even people can go, oh look, it's all clear in hindsight, and that's hindsight, isn't it? Everything's always clear in hindsight. It's just how it works. Show you a couple more examples. Let's have a look at gold. There was a good example I wanted to show you here. How did let me just got to get my bearings on the chart. And because this is one I spoke about. This is one I spoke about on my weekly market outlook video. And this is something I was talking about at the time, how gold was making new highs, but it was stretched above the moving averages, was coming up to a big resistance point. And then I looked at the RSI, and the RSI wasn't confirming. So this is where a few dots are being joined, in that we're stretched above moving averages. We're at a significant overhead resistance point, being these two previous highs. So it was like a double top resistance, and we had diverging RSIs. So I was saying at the time that this wasn't an asymmetric entry point, and the potential for a pullback towards the moving averages was I thought the possibility that was growing, and ultimately that's what happened. Didn't happen immediately. I'd been saying this for a couple of months, or at least several weeks. Took a little while to play out, but then it did play out. So that was helpful. Now, what's interesting here is just looking at this. There is a divergence creeping in now. So gold's making a new high. So people who like real-time analysis, this is real-time analysis, and the RSI currently isn't confirming. So what does that mean? Does that mean that gold's about to have a big pullback? Not necessarily. This is one where, so I probably wouldn't go out and buy a gold stock at the moment unless it had a specific individual situation. I bought a gold stock last week, and I bought another gold stock the week before that. So I have been active in the area, but I'm just a little bit hesitant just at this point in time, because we're getting closer to this big overhead resistance, and we do have some divergence. So for me, it'd be a case of not go out and sell stuff, because I don't think we're looking at a major turning point. But maybe, look, there's always open to the possibility that gold does pull back a little bit more, do a bit more consolidation, and then from there, maybe it then pushes higher. So I'm looking at divergence from this perspective, as in, is there a little bit more of a pause coming, rather than predicting anything dire. That said, and this is what makes divergence tricky for a lot of people to manage, is that divergence can often just disappear. So we can see the potential, and this is why it's an easy hindsight indicator. People will spot divergence in hindsight and go, oh, look how well that worked. But what often happens, and you often don't see this on the chart, is that, say gold continues on and starts testing this resistance, what we'll probably find, if that were to happen, is the RSI would probably rise again, and lo and behold, the divergence disappears, so you don't spot it when you're looking back in hindsight. That's sort of the thing to be aware of when you're trying to use something like divergence. Just quickly, another couple of examples. I'll let me find US 10-year bond. This was a good example, one I used in real time just recently. You can see clear divergence here in that we had the yield was making new highs, but we had obvious divergence, something I spoke about in my weekly outlook in that big resistance area. Let me just pop that on a weekly chart quickly. This is where I say I'm not using divergence on its own. I'm combining it with other things. So there was a big resistance area around 5% that had stopped the bond yield in previous times, and I was combining that with what I was seeing with the RSI to say, look, maybe this yield's going to pause here. Maybe it can pull back. Maybe that could become a tailwind for the stock market. Those dots all seem to come together over the last maybe the last 4 weeks. And one more real-time example of divergence. It's in uranium, and this one hasn't been playing out. I've been talking about this for several weeks in that uranium's been making new highs, but we look at the RSI, and the RSI hasn't. What's happening now, though? It's almost uranium. The RSI is starting to creep up and starting to cancel out some of this divergence. Maybe this is one which won't play out. I don't know, but I'm still hesitant to buy uranium stocks at the moment. Like, I'm long uranium and uranium stocks, and I'm not selling them. I'm staying with this broader trend. But in terms of adding to positions, I'm wary whilst I'm seeing this divergence, because we can't rule out we get some sort of a larger pullback in the uranium price, which could be a multi-month pullback because it has had such a big run, something like a 60% run in just a few months. That often leads to consolidation. So yeah, looking at that divergence, it's one of those things which I'll use when considering, like, do I want to add to a position here, or am I better just holding and seeing how things play out?
Okay, thanks, Jason. That's a good description. Now, a couple of questions for me. What? So you said you bought in a few gold positions, knowing that there's some bearish divergence potentially happening at the moment. What has to happen with the stocks that you bought into? That you said, because you say you're a bit wary, you wouldn't buy into them potentially at this point because it's overextended near the top there. Why did you buy those couple of stocks, those gold stocks?
Because
What's the criteria there?
Because just going back to this chart. Let me just find this gold chart again. So when I was adding to some gold stocks, the divergence wasn't there in that I added to a US-based stock a couple of weeks ago. So the gold price got to look back. A couple of weeks ago, the gold price was just bouncing off these moving averages. So, and with the individual chart for the stock, and I can show you. I'll show you the chart the stock I was looking at. A stock called Wheaton Precious Metals. And so I was looking at this stock, and it was starting to rally off these moving averages. The moving averages crossed, and it was just here. It was 45.60, I think, was my entry point. So I placed an order just as it broke above this previous high. So for me, that was an asymmetric entry in that I could have risk, relatively controlled risk, just beneath the previous low. Gold itself was just starting to rally off its moving averages, so it hadn't made a fresh high as it has now, and there was no divergence. And the price is higher. Wheaton's price is higher now, so I'm probably not probably wouldn't be as keen to add now. Maybe I'd be saying, well, look, we'll pull back and do some work. So for me, the entry point was a couple of weeks ago, and yeah, so it's not just one thing. You're looking at various factors when you try to pull all these things together. And divergence is it's a clue. It's not it's a clue. It's not, as I was saying, for me, it's sort of like a tertiary indicator. For me, things like the moving averages breaking to a new high, they're more important. If I see some divergence in something, well, then I might see, look, are there any other clues which suggest maybe we are heading for some sort of a reaction in the opposite direction, rather than using it as a standalone indicator on its own.
Yeah, right. Okay. The next question I've got, and there's probably a few in the crowd here. Do you use any other indicators to spot divergence, or is it just the RSI is the one that you
For
use?
me, I'm just look. I don't use that many indicators. I try to keep things pretty simple because they're like 1,001 indicators you can choose, and a lot of them do something similar. So you don't need variations, 5 variations of the same thing. So some people will use a MACD. I use an RSI. They're doing kind of similar things. There's rate of change. There's ADX indicators. All sorts of stuff you could use. But for me, it's all part of keeping it simple. Moving averages, have a glance at an RSI, but it's that overall momentum I look for, and the moving average and price breakouts are really the key for my strategy. Nothing wrong with all the other indicators, but I just don't think you need a whole lot of them on the go. The more stuff you have on the go, the more conflicting signals you get, and the more confusion you'll get, and you'll end up with just not being able to. Can make it harder to make decisions because you've got too many things that need to be cross-checked and ticked off, and you can end up doing nothing, just not knowing what to do.
Yeah. And I think I used to use one called the stochastic oscillator. But do you ever apply these divergences on individual stocks, or are you always just doing it on the sort of macro level there?
Yeah, individual stocks. You can get an individual stock, look at the RSI, and see exactly that same pattern I was showing in the S&P 500 or in gold or uranium, where the RSI doesn't confirm the latest price movement in the stock. It's just a sign that maybe things have run enough for now, and there could be some sort of reaction in the opposite direction. You can see it on weekly charts as well. It just takes longer to play out, and the bigger the time frame, the bigger the potential turning point. But weekly charts can be hard to trade off, and things can stay diverged for quite a while, and they're just more difficult. And as I say, over time the divergence can disappear, particularly in uptrends. And downtrends it tends to be maybe it's more it can be more timely, but I think it's just as applicable to a stock. But as I was saying with the back testing, I just couldn't really make it work. I couldn't get an edge from it. Like you could use it within part of a system, but unless something is providing a clear edge when you do the back testing, I don't want to use it because it just adds an extra layer of complexity to the process. I want to take the layers of complexity out of the process as much as possible. So something's got to prove itself as being a valuable and consistent partner in the trading process. Otherwise, it doesn't become part of. I won't try to systemize it. For me, divergence is very much discretionary, and it's an art, not a science. I don't use it all the time. It's just because I've been doing this for a long time. I've seen a lot of chart structures, so I can kind of recognize when I feel it's going to be possibly useful to me, and it's usually going to be when I can connect other dots to a storyline that go, yep, okay, there could be something here, rather than just going, oh, look, divergence, the market's going to reverse. It's usually not that clear cut, unfortunately.
Yeah. So you would use it more as a confirmation to potentially enter a trade, like, oh yeah, this is looking good, a good setup, versus a way to say, look, I'm not going to get in this trade because I'm spotting divergence. Is that right?
Yeah, it's an add-on. It's an add-on to support other more important factors.
Yeah. Have you ever used something? I mean, Brett's mentioned there's a commodity channel index. Very good addition. Have you ever used something like that?
Don't know that one. Don't know that one. Commodity
maybe we can have a look at that next year. We can have a look at that together next year. So there's other ones here that people. I mean, there's heaps of them, right? There's Kirby said the McClellan oscillator, very useful as a macro filter. So That's another good one there. Brett's also mentioned that you've shown a chart. He hasn't forgotten the name where you show the cycles indicating extreme fear and extreme greed. Sorry, using this as a macro in a combination with the individual stock assessment is helpful. Do you know that at all?
Oh, look, I see various indicators like that, which people publish, and I've got my own custom indicator called the Motion 300, which is part of my Motion Trader service, which does something similar, looking for where the market's moved in one extreme or the other, and they can be useful. They can be useful again in conjunction with other things, and often they're the most useful where they get to an extreme and then they reverse back in the opposite direction. So somebody can sit in the extreme camp for protracted time, but it's then waiting for that reversal. Maybe there'll be a trigger level where the market hits a low point, sits there for a bit, and then moves back up. That's a trigger level, and that can be a point where a market will generally start to see upward momentum come back in.
Okay, all right. So obviously this is a custom indicator you've obviously constructed, Jason. So if you do want to have a look at it, then you can always just have a trial of Jason's service at his website as well, motiontrade.com.au. Feel free, guys, just once again give us a like and comment down below as well. Let's get on to some questions, Jason, that we've received from our audience so far. Now, some of these are simple. They've probably been answered in previous sessions, but we can just have a quick fire session here, I think, in terms of some of these questions. Could you share some settings in the TradingView Scanner for 2 moving averages? So I'm not 100% sure what he means by trading. I know there's a scanner of TradingView for 2 moving averages. Would you know how to answer that one there? Could you share some?
Yeah. Scanner. Yeah. That's I don't use TradingView's scanner because I've got my own algorithmic setup, my own software package where I do all the number crunching and stuff. So, but look, yeah. So I'm probably not going to be answering the question he's wanting. But for someone who is interested in TradingView, just look, the way to get indicators is you click on the indicator section, you type in what it is you're after. So say we're after a dual moving average. Just type in dual, and chances are there'll be a dual exponential moving average. If you want to save it to your favorites, you just click on the star, so you don't need to search for every time you want to apply. You just click on that, and then when you click on your indicators, you'll see it there. Let's just add it in, and it's actually the same one which I'm using myself. So I've got my one already applied. I'm using 50 and 100 days. You can just move the cursor along, find that little cog, that's a setting, and you can adjust the time period for your moving averages. And it's find all the other indicators you want here as well. Like if you want to use an RSI, just come in and type in RSI. So there you go. There's all sorts of things in the TradingView community, and these are so they don't seem to be TradingView pre-programmed. They seem to be indicators provided by the TradingView community. So you go through, maybe you need to look at a couple of them to find the one which looks best and works best for you. But there's a stack of stuff here.
I will allude people to I've had a look at it before, but this might also be what he's referring to. If you go to stock screener down the bottom left-hand corner, you can actually, if you click on the stock screen, you can. I think in this one here, you can actually choose to see. If you just click on that, you can choose to see which stocks have had their. So if you click on filter there on the right-hand side there, filter on the right-hand side, And you can scroll, you can just filter on any of these stocks on a technical basis here. So you can actually, if you scroll down, see where it says, show me, if you scroll down there, it'll say, show me all the stocks that have just crossed over the 50, over the 100 moving average, right? So you've just got to find the section there. That may what he's referring to.
RSI, average true range. Yeah, this is interesting. New 52-week highs and lows. So there's a whole stack of stuff. Here's some moving averages down here.
Yeah.
So you just put in, below the value below the 50 moving average.
Yeah.
And yeah, look, that's an interesting thing. And you'd be able to. So there's they've already got a preset 50-day moving average. It looks like. So it could be, doesn't look like they do a crossover, moving average crossover from just this quick. I'm looking at this for the first time.
Yeah. If you click that below button, click the below arrow, and there you go. It'll say above, crosses up, crosses
Yes,
above.
you've got crosses, and it'll probably combine in with something as well, crosses, and this might be where you put in what you want it to cross. So yeah, look, that's a really interesting way to be able to scan for some
Stocks.
Some stocks, yeah.
All right. So the next question I have here, and this is another quick fire one, Jason. Out of all the strategies that you've come up, you've been through the years, what's the simplest way that you can think of making money using technical analysis? It's a bit of a funny one, but we got it. So
it's look, you know what? I think the simplest way is you look to buy stocks that are above the moving averages. You let those stocks which you buy above the moving averages, you let them run. You have an exit strategy, so you cut them if they don't run, and if they do run, you have an exit strategy to cut them when they turn lower. It's really just I think keeping it simple. I think the most important point is risk management. It's like you can look at all the patterns and all the setups and stuff you want, but unless you have a good risk management strategy, I think you run into trouble. So I've seen back testing where you can have a really good entry strategy, but then you take off the risk management component and the strategy is a disaster because we never know which setup is going to be the next big winner. You can have two identical setups. One goes up a lot and one goes straight down. So you don't know how a setup's going to play out. You know what the risk reward potential is, but you've got to have risk management to be able to manage the scenario where it falls. But then you can do another back test where you could have a random entry. So you just get the algorithm to randomly buy a stock every month, above the moving average, below the moving averages, whatever, random. But then you apply a rigorous risk management strategy, and that strategy can actually do well. So people get so focused on what's the best buying trigger, what's the best entry point into a stock, and when should I buy, what should I be looking for? But it's often the risk management which is really more important. It's like making sure that when you lose, you're siloing that loss, you're cocooning that loss, so it doesn't become a disaster, and you're spreading your risk. These are the important things. Then you're letting profits run, and you're cutting. You're taking profits in your good positions when they fall back. It's the simplest strategy, I think, using a moving average is buying stocks which are breaking out above moving averages, but then applying the risk management. That's really I think that's the key to it all. And because it's all clear in hindsight, but you got to be able to use those that risk management.
Yeah, and stick to it. And I think there's plenty of our series has plenty of information around the middle of our series, which talks about how to apply your stop losses and when to cut the losses. Right, so that's part of this next question. But my would you buy stock as it's falling at all?
Generally speaking, no. Like you've got to define what's falling. Now, are we falling back towards rising moving averages, or are we falling below declining moving averages? So both stocks are falling, but for me, they're in completely different categories. So I've got no interest in buying a stock which is falling below declining moving averages, because that's you're on red alert when that's happening. That's the time when something can completely unravel. When a stock's coming back towards rising moving averages, well, then I still don't want to. If you're buying it around support, as it's coming back to rising moving averages, and you apply risk management, well, yeah, look, that can be a buy on dip. That's the sort of dip I want to buy. I want to buy a stock which is dipping back towards rising moving averages. So yeah, look, there is a time and place. Another strategy would be let it come back and then buy the rebound if you want to buy into some strength. But yeah, buying a stock coming back towards those rising moving averages can and is a viable strategy.
Yeah. Okay. All right. Let's have a jump and let's have a look at some of the stocks that have come in. Jason, can we have a look at? There's a few here on chat that we got to get through as well. So hopefully we do it within the next 20 minutes or so. We've got PLS to start off with. PLS.
Right. Let's have a look.
It's Pilbara Minerals, isn't it? This is hot topic. Is that right?
Yeah. So let's just get that up on the screen. So, well, this kind of backs into that last question. The stock which is falling below declining moving averages. We must have spoken about this previously because I've already got a support line drawn in. It's so this isn't the sort of situation for me. I'm not going to buy a stock as it's falling below declining moving averages. That said, it's like when I compress this chart and have a look at it, like we can see there's been a clear upward trend in this stock for a while, and big moves lead to big consolidation. So one possibility with PLS is that we've just seen the classic zigzag sideways consolidation following a big up move. It has come back to a support level. So what we really have this big trading range, and you can say it's currently trading at the bottom of the range. As I keep saying, for me, it's not. I don't want to buy a stock which is below the moving averages, but I can see a scenario in this one. This is a different situation to a stock which has been trending lower below moving averages for months and months. This is one which is going sideways and is at the bottom of the trading range, sitting on support. So a case could be made that someone might say, someone might really like PLS, says they like the fundamental story, something about it works for them. They say, look, technically it is sitting on support. I like this stock. I want to get exposure to this stock, so I could buy it at current levels, and I could put a stop loss say 10% lower, maybe give it a bit longer, maybe give it 15% below the market. So say we did that, put a entry at current levels, and this isn't a strategy I'm recommending. It's just one scenario which someone could play out. So in at current levels, stop loss just beneath the market. So what could happen from here? And you go, okay, well, what if the stock were to rise back up towards the top of the range? Well, that is a 53% move. So what we're risking 15%, potentially get top of the range, say 50%. So we've got 3-to-1 risk reward. What if this pattern were to sort of move back up towards the top of the range, pull back a bit, then break higher and go on a bit of a run? Well, then you say, well, look, if it did something like that, well, then maybe we're looking. You start talking, look, this stock could double potentially. It's got that potential. So that's where you're getting that asymmetric setup. Relatively small risk, large potential upside. It stacks up as an asymmetric point, even though you are preempting. You're trying to preempt a low point, but you do have some parameters around picking that low point, as opposed to, say, let me just call up a stock which I know has had a big downtrend. as opposed to getting a stock like, let me just resize this. Would I fit the screen? As opposed to jumping in something like A2 Milk and saying, "Oh, look, it's fallen a long way. Surely this is a good buy now." There's where's your structural reasoning for doing that? It's not in a range; it's just in a downtrend. So this is a really dangerous situation to be buying a falling stock. It's quite a different setup to what we're currently seeing in PLS. When you got stocks doing this, like some people say, look, big rally off the low. Maybe this is a turning point, but the trend is so clearly down. I just don't want to play that. So different situation with PLS.
What about PDN?
PDM, so that'd be Paladin.
Yeah, another mining, is it?
So that's a uranium stock, and this is interesting because we're just talking about uranium a moment ago, where I was saying we had that divergence on the uranium chart. So interesting one in that. So they operate a mine. I think it's in Mali in Africa. They put it on care and maintenance a few years ago when the uranium price was low, and I think they're in the process of restarting the mine. So it's got this large world-class uranium deposit. And I could be wrong with Mali, but it's somewhere over in Africa. So big upward trend. As we say, big upward trends lead to big consolidations, and that's been the case with Paladin. It's moved sideways to lower in this trend channel. Recently had a breakout. Breakout was in September, just a couple of months ago, and what we've had a bit of a run, pull back to the moving averages. So I was talking earlier about, look, if I'm going to buy a falling stock, it's going to be a stock which is falling back towards moving averages. So this becomes a potential point of interest around the this is a 50-day moving average. This is 100-day. So somewhere within that vicinity, that's a point of interest. It has so far found support. It's rebounded off there. Question is, does this need to do some more work, or could it run now? And it's a tricky one, because when I look at that uranium price, I am nervous about the potential for a multi-month consolidation in uranium. So I'm hesitant to buy uranium stocks at the moment. But if this were to break higher, say it were to break above these recent highs, if we were to get a move where it nudges higher, or maybe if you want a uranium exposure, or you want to add to it, well, that is certainly a point where you're potentially adding to it. I think the overall structure of Paladin looks good. It's just what happens over the next few months. Doesn't need to do more work before potentially going higher. And of course, it mightn't go higher at all. Maybe the whole sector crashes. We don't know. I don't know. But I'm working on the basis that I think the overall trend is up at this point. So for me, does it need to do more work and then possibly move higher, or is it ready to go now? That's what I don't know. The uranium divergences is the swing factor for me, which sort of puts me off participating at the moment or buying more at the moment. But I think the overall structure is encouraging. It's just how you time it at the moment.
Okay. What about we've got a DHHF? Must be an ETF or something, is it? Or
yeah, it is. I had a look at this one earlier. It's an interesting one. What this is, it's a beta shares ETF, and what it is, it's a global high growth ETF. So they've got exposure from they've got stacks of companies from many countries, and they're all focused on high growth. So I think something like 35% from ASX, 35 US, not quite those percentages, but thereabouts, and then the rest of it is an assortment of other countries. So it's it's an interesting concept for getting high growth exposure. Looking at this chart on its own, just looking at the chart, not thinking so much about what it does at the moment, it's sort of like, well, it is range bound. So just going from the highs from December 21. So you can say it's been traveling within a large range for the last 2 years. And then in more recent times, we could say, well, look, and it's on a near-term basis, it's within a range from the high in September to the low in October. So it's basically a range within a range. These moving averages, they're kind of in no man's land at the moment. They're not going up, they're not going down, they're kind of just sideways. Prices above the averages, which is positive, but I think that one positive price being above the averages isn't enough to compensate for the fact that the averages generally aren't really trending in either direction, and we're in this double range bound period. Now this could well and truly stabilize and then break up. So maybe this is a great medium to longer term stock to put into a super fund and not think about for the next 10 years. I don't know, but from a current standpoint, it doesn't really excite me too much. Then I look at its performance since the October low last year. It's currently up about 17%. So if it's high growth and it's up 17%, well, then I look at the NASDAQ, it's up 50% or so over that same time frame. The S&P 500 is up 30% over the same time frame. This is a high growth ETF and it's up 17%. So for me, it's not one to rush at. I think it's an interesting concept, but I'd probably need to see it do some more work within the smaller range and then start to break out and then weigh up the options about what it's doing compared to what other growth-orientated ETFs are up to.
Okay, great. So now we've got MJ who suggested Karoon Energy, CAR.
Yeah. It's that has had a bit of a pullback recently. So let's just call that up. Okay, so this is interesting. This is so had a breakout. So it's so we had this really nice uptrend from March 2020. Really great period of upward price momentum, and then as almost always happens, big price moves lead to big consolidations, and then we've had nearly 2 years, probably maybe 18 months of sideways. Had a breakout in August. Now this is a false break. Price broke upwards, consolidated above the breakout point for 2-3 months, and just recently has broken back down beneath the breakout point. Coincides with the big pullback we've seen in the oil price. Moving averages are now rolling over, about to cross to the downside. Prices below the averages. So this is one which has gone from looking good about a month ago to now looking at best that it's on hold for a while. So it's not one I'd want to buy now that it's sitting below declining moving averages. I look at the oil price itself. I don't think the oil price looks like it's about to go into a tailspin. There's plenty of support beneath the current price, but a stock like this, it's a tricky one. If it was in my portfolio, depending on where I got in, if I was in above the breakout point, if I'd bought the breakout and it's now below the breakout point and moving average is declining, I've really got to consider exiting the stock. If I'm in from down here somewhere and I've been able to ride off these pullbacks, I'm probably still in. I'm probably still in for the medium term. So a lot depends where I'm in with how I'm going to handle it. If I've got a position, but if I don't have a position, I'm not looking to establish it just now. I want to see how this plays out. Does it start to build some sort of a base over several months and then start to round higher again? Then I become interested, get it back above these moving averages. But that's going to take a bit of time, I think, to establish some upward momentum again. So I think it's a case of if you're interested in it but not in it, I think you've got time to watch it, see what happens. And if you're in it, you've got to know what your exit strategy is, just in case things continue to deteriorate. I don't know that they will, but you've always got to be aware of that possibility that stocks that you thought were going to do really well, something can change and they can deteriorate. Not saying that's going to happen here. I don't know, but it's that risk we're always managing. That's what we we're talking about before. It's risk management, like managing the possibility that what you don't expect to happen happens. That's how we stay in the game, because we're prepared when things go amiss.
Okay, we got a couple from Fred here. FMG and RSI. I don't think that's the indicator. I think that's a
RSI. I don't think I know that stock, but I do know FMG, Fortescue, which has been doing well. The iron ore stocks generally have been doing well over the last few weeks. And I think something we've actually been speaking about recently. Maybe we've spoken here, but I've definitely spoken about it in my weekly strategy updates. So we'll start with FMG. And yeah, you can see I've already got lines drawn on because it's something which I've spoken about. So we've got a breakout a couple of weeks ago. Moving averages have crossed. We had a period. Let's just compress the chart a little bit. Yeah, so we had that big upward trending phase. And then really since January 21, so really what's that, 3 years now, kind of been just this big sideways period. And now looks like, so the moving averages have crossed to the upside and we've got the breakout. So for me, this is a stock which I'd consider owning. Approaching these would be all-time highs, I'd imagine, but the underlying momentum in this stock is up, as it is with BHP and several of the other iron ore miners. So what's happening in iron ore? Why is iron ore running? I don't know. I don't know the macro story behind it, but they're running as a sector, and the momentum is certainly to the upside. And also in terms of managing risk on this one, it's like, well, if the price were to fall back down, kind of like what we're talking about with Karoon, like if the price were to fall back down within this range, always give it a bit of breathing space, but move back to say $22, then you'd say, well, look, that would probably be a false break back down below the moving averages, below support, which was resistance, which is now support. That would be a warning bell that something was amiss, but that's not the case at the moment. But it's understanding all this in advance. Where are things going wrong? Where's my view start to really become challenged?
Can I ask with the FMG? We're actually looking at the RSI with FMG. So can we have a look at the RSI on the FMG chart?
Yeah, we can put an RSI on that.
Might have something to do with the fact that the former CEO just bought the Karuba brand as well. Not Karuba. What is it? What are the Aussie? I've forgotten what the name of the hats. Karuba.
Goodness me, I know it so well. Now you've thrown it out.
Yeah, exactly. I just said it last week, and if anyone on chat there, famous Australian hats that we have.
Kubra hats.
Kubra, that's right. Kubra hats. That's the one.
Karoon and Karuba, and you're throwing me off, Rog. RSI is stretched and is coming back, but I don't use the RSI from this perspective because the RSI can remain stretched for a period of time. It's like you look at. Let's just see what we get when we do this. So you could have looked at this in. So I'm just looking at this point from 2016, where the RSI got quite stretched, but the price just kept running. So I don't worry when I see the RSI get overbought. It's the divergence which is the factor I look for, which I can find useful, as I said, as a tertiary support to other things which I'm seeing. Things can stay overbought or oversold for a protracted period. This could chop around up in this range for months, and the price could go considerably higher. So it is overbought temporarily, but it has had a big run. It's had a breakout. It could well consolidate above the breakout, and then have another rise. So yeah, it doesn't. I don't think the RSI adds a lot of value for me in terms of working out like what I'd want to do. The just the natural things I'd tell you is, yeah, the price has become a little bit stretched above the moving averages. Maybe it's got to pause, let the moving averages catch up. You know, you could get a bit of price action like that. Often see we get market moves into some sort of a compression range, and during that time the moving averages will catch up beneath it, and then you have another run off the back of that. So that's one type of scenario which can form in these situations. You know, one of many. Looks like the near-term upside might be somewhat limited, because if it were to continue running now, it gets more stretched above the averages. So that's why I say some sort of pause would be normal. But yeah, breakout looks in good stead at the moment.
Okay, so we've got
So was it RSI? That was the other stock.
No. We were looking at the RSI on.
Got you. Yep, understand.
So we've had a look. I don't think. Well, I can't see any sort of potential there. But let's just move on to VHT and RMD.
VHT.
Yep.
So I recognise the name. It's been a motion trader stock in the past.
Looks pretty flat to me.
And so the way so I would have been playing this as a motion trader stock back early this year, where we had the moving averages cross, we had the good price run, came back to the moving averages, got a bit of a compression range. It was all looking encouraging. Had another run, but then over the last few months, it's all just come right back. Yeah, it's come back, and as you say, it is looking pretty flat now. It's lost that. It looked to have this nice stepping pattern to it, but rather than stepping up again, it's lost its footing and it slipped back below the moving averages. Moving averages have crossed. So for me, it's not one I'm actively looking at now. Like, yeah, maybe it does look. It could form. There's certainly, you could make a case there's some sort of support coming through somewhere around this region, around 65 cents. Maybe it's basing again. Maybe it starts to round higher, the moving averages cross, and has another run higher. But there's nothing immediately which has me wanting to look at it. You can see where I'd had a pattern drawn in previously. I had this triangle drawn in, and the price had broken up, so it was looking interesting. But this is the thing. We never know which setups are going to be the successful ones. A lot of setups will fail. And this is what throws a lot of people off. They say, oh, look, your setup didn't work. No, it didn't work. A lot of setups don't work. That's not the point. It's not about finding this mystical setup which just leads to ongoing reward every time you find it. It's like a lot of setups will bring you in and then they'll drop you out. That's why we've got the risk management strategy to contain the loss when that happens. So it's not a big deal. It's like, sure, it failed, big deal. Let's move on to the next setup, which might look identical, but this time it might run 50%, might run 100%. Who knows what it's going to do? It's just finding where the risk reward is in your favor. You're playing the odds. That's what this is. It's a game of odds, and just play those odds time and time again. And you're going to get a sequence where it just doesn't work out, but then you go into a good period and you're letting your winning positions run when they're running. That's where the money's being made, and you're containing the losses when they're not working. So you end up with this lopsided skew towards positiveness, because you let that positive tail run, and you cut the negative side at a relatively early stage.
Speaking of the next setup, let's have a look at RMD.
ResMed.
No, I think this is one we've looked at quite a lot.
We have, and nothing's changed. Consolidating below declining moving averages. Not for me. I think this will take time to turn around. It's I don't think we're going to see anything exciting from ResMed over the next few months,
unless something in the company happens. That's it. So LTR, we've got LTR,
lithium. Lintown.
Yeah,
This was a takeover which went amiss. So Gina Reinhardt, she bought a position, and I think it scared off the bidding firm that wanted to take it over, and that's where we got this collapse. It's one I'd just be leaving alone. Like, we don't know what's going to happen. Like, is it going to continue to drift off? Like, there was a company that wanted to take it out, so you'd think, well, look, there must be value there, and what's Gina doing there? What's going to happen? But do you really want to play that game of what are they up to? We don't know. Are they going to come back and have another go at it? Is there going to be a higher price? Maybe, maybe not. We just don't know. Lithium in general has been coming off over the last year or so. If you're in a position and you're stuck with it, what do you do now? It's like, for me, I'd probably bite the bullet and cut it. If it's a relatively small position, it's hard. It's hard when you get a situation like this and the bottom falls out of it, and you know why it's fallen out. But it's, as the facts stand, when we look at this chart, not knowing anything else, it's gap down below declining moving averages. It's not where I want to be.
And there's quite a few which unfortunately we probably won't be able to get to today, but it's great seeing you guys bringing these things, right? But we'll finish off on NIS, if that's okay. Hopefully
sorry, what was that one, Rog?
NIS.
Nickel search.
Here we go.
Yes, a relatively new stock, and that's interesting price action. So the moving averages have crossed. So this is stacking up as one which is interesting. Like you can see, like wonder whether we get some sort of trend channel. No, you don't really get a trend channel, but you get you got a clear sort of downtrend in the stock. So it's broken the downtrend. Moving averages have crossed. It's broken to a new high. It is stretched above the moving averages. So some sort of consolidation would be possible here. It's like it's a low price stock. These things can do anything. These low price stocks, they can be quite volatile in how they play out. It's tricky. So if you were to buy a position now, where do you put your stop loss? And so this stock could pull back to, say, 9 cents and still look good on the chart, but that's 35%. From current levels down to 9 cents, 35 cents. So, what if we were get some price action like this develop over the next few months, back to the moving average, chop around a bit, and then start to run. So something like that could develop. You got this risk, this pullback risk. How do you manage that? So these are trickier ones to get on board. Ideally, like, I'd probably want a trailing stop back below this low point from November. But then what's the risk on that? The risk on that is kind of looking at like a 45% stop. If you just use 10% or something, it's like you can just get knocked out tomorrow, just a noise. So it's a harder one. It's harder when that happens. You kind of got to get these ones early on the break, or if it goes through some sort of a consolidation, like I've got on the screen, then you get the sort of the rebound off the moving averages after some sort of consolidation. You kind of need to wait and see how the price action develops, what it looks like. The chances, could it do that? Could. But I don't know. If it does, I'd say, well, look, I've just missed that one. It's too hard for me to get on board just at the moment. Even with a small stake, you still got to give it plenty of room. So I think for me, I think it's really interesting. I like the structure. I've probably got to wait for the consolidation so it can, because I've got to understand my risk. At the moment, it's too hard to get a handle on my risk. I can see the potential upside, but I can't get a good handle on where my risk is with this one. So that's the tricky part. So I'm always, when I'm looking at a stock, I'm looking at how much I could lose before I start getting excited about what I could make. that's too unclear for me at the moment on the risk side. But generally, yeah, it's looking like an interesting stock. I think that's one. Yeah, we may see again.
Well, it's a good one to finish off on, unless it's a pod that's going up, which is good to see. Jason, I got one question for you. What are your rules around trading around Christmas time? When do you stop? Do you stop? How do you do it after all these
I
years?
go through rules. If I'm getting a breakout in a particular stock, it's yeah, I'll take the breakout. It's the markets don't thin out that much. You can't take positions. But then if you want to go to the beach and have a couple of weeks off and not look at the screen, that's all fine too. I tend to stay in touch with things. I have a look at things. If I need to do something, I'll still do it.
Yeah. So no rest for the wicked for you. For you, even putting on positions even throughout that Christmas period. Very good.
Years of conditioning. The markets are open and doing stuff, and can't help but have a look.
Fair enough. All right. I think we might leave it at that. I just want to say thank you for everyone for coming and their ideas as well. We'll continue this next year, I believe. We'll probably look at coming back. We're going to have a bit of a break over this silly season. There's a lot happening for us both. So we'll probably look at coming back around mid-July, mid-January. In 2024, and I do look forward to it. I do look forward to coming back and coming up with some new ideas on how we can format this as well, right? Because we sort of, we've done that sort of 12-week, 14-week period of education as a basis as well, right? So if you're missing us, well, you can always see Jason 1:00 on Fridays for free anyway on his channel. But you can always go and revisit some of the stuff that we filmed in the past 12 weeks, right? And just confirm some of that knowledge and develop what you need to develop out of that. But for now, Jason, I just want to say thank you very much for everything over the last 14 weeks and much appreciated.
It's been good. I've enjoyed doing this. And I think moving forward, I'd love to get lots of questions as we're getting today coming through, because that's what's interesting, responding to questions rather than me telling people what I think they should know. Done that. Now it's about being able to help people find out about what they want to know, including going through and doing the analysis of those stocks. Like that last one we did, it was fun doing that. Just going, how does this work? And trying to put the pieces together and how we could find a potential setup, a tradable setup from it. So we can do a lot more of that. That'd be a good thing to do. So thanks for having me on, Rod. It's been fun.
No, it has. Thanks everyone: Shannon, MJ, Rodney, Tommy, Brett, James, all the regulars. I can't name. There's quite a few now, which is great. Yeah, we look forward to coming back next year around, like I said, mid-January, and yeah, having some fun.
Yeah. So make sure you're on my database, and I'll send you out my weekly market outlook videos, and yeah. So I'll be in touch over the next few weeks through talking about the markets generally.
Of course, and yeah, like I said, this is a joint effort between Selfwealth and Motion Trader, Jason at Motion Trader. So go check out his website and what he has to offer. There's a link below. I mean, I'm sure a lot of you are Selfwealth members anyway. If you haven't, there's 10 free trades and a link below. Love the comments. Keep them coming. Give us likes and subscribe. And thank you to Rob, who's doing all the stuff and behind the scenes for getting that show going, even with a few hiccups throughout this period as well. But thanks, Jason.
Thanks, Rog. And of course, Rob, thank you. And viewers, thank you for being such an important part of making it all work. Thanks for coming along each week.
All right. Take care, guys. Bye-bye.